Hello from Trend Signal for our review of the data and events the week beginning the 4th of July. US holiday on Monday, Independence Day. The volumes will be lower, but not the volatility. I guess not many US asset managers will be taking the whole day off. There has been a bounce in equities, the Carney bounce, as it's referred to last Thursday afternoon, when Mark Carney, the Governor of the Bank of England, said the Monetary Policy Committee will be cutting rates in the summer as the economy slows post-Brexit. So we, in common with others, expect a rate cut in the next couple of months. In fact, that the MPC do meet on Thursday the 14th for the first time post-Brexit, although I don't believe they'll be cutting rates then. But unfortunately, savers have been squeezed again, and borrowers, I guess you could say, have been let off again. Markets last week, extraordinary moves, something that not many analysts would have predicted. The FTSE 439 points, up 7%, eclipsing the August levels from last year in an extraordinary move. Even the FTSE 250, which is more represents a UK PLC, was up 335 points, about 2.1% last week. Although on Monday, we have already seen a bit of a pullback in the FTSE 250 following some appalling construction PMI numbers, which has hit British Land, Land Securities, Barratt Development, Persimmon, Taylor Wimpey, the usual suspects, as you can probably imagine. But the FTSE 100 squeezed sharply higher last week. International-based companies, the big dollar earners, benefiting hugely from it. Defensive stocks doing quite well, and the usual story, the vulnerable sectors that have been struggling in the run-up to the referendum, the likes of the banks, insurers, house builders, airlines, still struggling. Although a probable rate cut in the UK could well help some of the house builders, but certainly not the banks or insurers. Bond markets, well, bunds up 145 points last week. Gilts, extraordinary move, up 231 ticks, I believe, and that is despite the political turmoil post-Brexit, despite the credit rating downgrade. UK gilts, they've fallen in terms of yield to a record low last Friday of 0.78, so that's down from a pre-Brexit level of 1.35% yield. Not what most had expected, really. Similar to the doom and gloom surrounding equities on Friday the 24th. A long way to go yet, of course. We don't have a Prime Minister. We don't have a leader of the Tory party. We don't have an effective opposition. We don't have an effective leader of the opposition. So politically and economically, we're at sixes and sevens, obviously. Post-Brexit, well, the Tory party need to get this election sorted out. It's down to a two-horse race between two women. Theresa May, seasoned campaigner, who's held the office for a Home Office cabinet post for 6 years and has been an MP for 19, 20 years, something like that, as opposed to Angela Leadsom, who's been an MP for 6 years and a cabinet office minister, I should say, for 1 year, I believe. The Tory Parliamentary Labour Party, they conduct the secret ballot to decide which two candidates go forward to vote by the general membership, and it seems pretty likely at this stage that May and Leadsom will go forward. Currently, May is by far and away the favourite, the bookie's favourite. Although, of course, being favourite guarantees you nothing. If anything, being favourite guaranteed you failure. At least it would seem. Witness the Brexit vote and also the subsequent demise of Boris Johnson. Let's have a look at the data this week. We've already discussed the construction PMI, which is extraordinarily weak. I think it did start to tail off because of the Brexit vote, the uncertainty surrounding that, which is the reason why it tailed off. But the worrying thing is that it's fallen that much before the Brexit vote, the vote to leave the Union, then we could be in for a bit of a tough time there. So let's have a look at the rest of the bits of data out this week. It's non-farm payroll week. Normally the first Friday of the new month, which would have been last Friday, but for some reason it wasn't. Anyway, it's this week. But let's start off with a sort of the key announcements this week. On Tuesday morning, we'll wake up to the results of the Reserve Bank of Australia's monthly policy meeting. they've got a bit of a hung parliament, or the potential for a hung parliament, following the election over the weekend in Australia. The Aussie dollar dipped, but then rallied, curiously. We're not expecting any rate move from the Reserve Bank of Australia, but that's one to watch on Tuesday morning. Then we have the Services Purchasing Management Indices, or PMIs. Services are a lot more important than manufacturing to the economies these days, not just in the UK and the US and Europe. 53.1, slightly softer number. And then we have one of the first of central bank speeches. In fact, this is the one we've focused on. Mark Carney is talking about the financial stability report, but inevitably it'll be about the economy, the wider economy, and post-Brexit issues. So that is 11 o'clock on Tuesday. The following day, we have Mario Draghi talking at 9 o'clock on Wednesday morning, the second major speaker. In fact, he tends to speak multiple times. Last week, I think he was slated to speak 3 times. Only once this week, which is a relief. We then have the service PMI from the States, called the non-manufacturing PMI. We call it services, just to be very clear. And then the FOMC minutes from the previous meeting. Be interesting to see exactly what weight Yellen and the Federal Open Market Committee assigned to Brexit. It would appear that was a major decision why they've rowed back further from interest rate rises. It certainly now looks like the market is saying there's going to be no rate rise this year, if not until spring next year. We may get further clarification from those minutes about that. Kuroda, the governor of the Bank of Japan, will be talking overnight, Wednesday night, Thursday morning. And then really the lead up to the non-farm payroll, we've got the ADP non-farm employment change, the private payroll data company that has some moderately good insight into the level of employment or unemployment in the States. 151,000, slightly lower than the previous number, at odds with the Bureau of Labor Statistics data, i.e. the non-farm employment change. But let's just jump to that. So Friday is the main event of the week, non-farm employment change. Horrendous data the previous month, 38,000, confounding absolutely every expectation. No doubt we're going to get a bit of a rebound. We're looking for 181. The number could be even higher than that. And watch out revisions for previous numbers as well, as that is likely to happen. The unemployment rate, because of the number of participants in the labour market increasing, the actual unemployment rate, they reckon, is going to tick up slightly from 4.7 to 4.8. That's it. Thank you very much for listening. Bye for now.
If you would like more information about trading the right way, Trend Signal is giving you the opportunity to see and hear about its services live at a free online seminar. Take a look at the Trend Signal website for the latest events and to book your free place.